Welcome back, ladies and gentlemen. As promised, we're going to begin our Fed preview with our special guest today, event trader Gavin McGuire and chart trader Brett Manning. Good morning, gentlemen.
Good morning, Jim.
Good morning, Jim.
So, Brett, before we get into the projections that you guys may have in our preview for Fed, I'm looking at the market, trading at its session lows. Anything to make out of this, or just maybe some squaring away ahead of this event?
I suppose squaring away ahead of the event is a reasonable way to look at it. We also did hit important resistance, and yesterday we importantly sold off in the afternoon after making a new spike high. So there's some kind of technical rhythm issues for the market right now. Maybe there's a little bit of a pulling back in of risk. I think that the fund manager survey data we got yesterday might have been a little bit backward looking. The title was basically, we're really jittery and we don't like stocks, or something to that effect. And I think that was the case up until midway through last week. And then we started to see big fund flows into equities, and that showed up in the fund flows data. And in fact, I think one day last week was the largest equity fund inflows since September of last year, which was, I think, the actual day of the top in the market. So I think that we did start to see a bunch of money slam into things, and I think maybe the fund manager survey was a little bit backward looking. They probably need to go through a few weeks of getting in touch with these guys and compiling the data, and it may not really reflect where things are right now. But I think that's become such an influential report that maybe there was speculative money coming in off of that fund manager survey. So I think it might be being gamed a little bit right now and maybe having some common knowledge failings. So I feel like it's possible that this was a little bit of an important inflection over the near term. And then with the Fed, if we do have a bunch of new money that flowed in risk last week, and the kind of idea right now seems to be that the Fed is sort of priced for perfection on the dovish side, then maybe, there's a little de-risking here.
So it sounds like people are speculating on what the results will be of that particular survey, right?
Or at least reacting to it. I mean, if it's become, I think, a pretty influential data point now, because it's such a significant. I think it's a couple hundred fund managers managing $500 billion, and basically the idea is if they're not in stocks and the macro data is starting to improve on some level, or at least we've got a Fed that's not out of line relative to the macro data, then the supposition is that, well, these guys are going to have to get in the game at some point because they've got to be way behind their benchmarks right now. And I think if you get a really clear signal of that, I think it probably does spark some capital shifts just in reaction to what that survey says. I think it's become a relatively influential data point.
Let me ask you one last thing on that. If it's only I think that's a pretty small sample of managers and the amount of money that they're actually running. What would be their incentive to actually tell the truth in that, especially if they're behind?
Huge point. Yeah. No, I totally believe. Right. There is this second level kind of analysis that I've talked about a few times with that report that makes it really kind of difficult to judge. For instance, I think one of the most interesting ones is when they talk about the most crowded trade. Because that's the question. The question is, call up a big fund manager and say, what do you believe is the most crowded trade? That you're not going to hear from them what they're most crowded into. In fact, you're probably going to hear from them what they don't own. Because they believe it's a crowded trade. It stands to reason they probably aren't overexposed to it. Mm-hmm. So there's a lot of little issues like that in the way that survey is structured. I think people take it to face value. But yes, there is another point that comes up. If it is being gamed and if it is becoming an influential data point. And I think that, it's a small number, but it's a representative number. I think that it probably is representative. I would go ahead and take a flyer that whatever there that is an honest appraisal, like, for instance, maybe cash levels, that probably is representative of the larger system of fund managers. I think you've got enough there that it would be peculiar if it's not at least as good as a political poll. They don't get every voter in the poll, but the polls end up being usually pretty representative. So I think that it's probably representative of attitudes. The question is, if they know that it's become an influential report, just like you said, do they game it a little bit? If they're really long, do they say that they don't own anything because they want people to react by buying? I don't know the answer to that. and it is a little bit trickier on the analysis side than some of the other data points I use. So yeah, there's a lot of issues there.
Yeah, well, the more influential it gets and the more buzz it catches, the more likelihood that there may be some gamemanship going on in that one. So
absolutely.
I mean, yes. Hey, you know me. I love a conspiracy theory, and that gets my brain popping. So anyway, enough about that, Brett. We can talk about that in days ahead. But let's focus on the Fed right now. And the first place I always look to is where we are in the Fed funds futures. And this is a good place to start, as it gives us a good sense of the expectations coming into this event. So you and Gavin have had some time to break this down. What should we be expecting?
You want to take this, Gav?
Yeah, sure. And expected in terms of just from the Fed overall statement, or for the Fed funds futures?
Give us a baseline of what the Fed funds futures are and what that actually means.
Yeah, I mean, it's just a measurement of the market's take on where they expect rates are going to be going. People are always looking at the divergence between the market outlook versus the Fed's dot plot range. So obviously the dot plot's going to be in focus. This is the March meeting, and every quarter the Fed updates their dot plots and their economic projections. We have a pretty fair idea of the language that the Fed's been using as of late. So what people are looking for is that more dovish tilt that we've seen in the Fed's language being reflected in these economic projections. One key item, of course, again, is that dot plot. And currently what we have right now, and if people are referencing my preview from yesterday, it was posted at 12:22 under the event ticker. We could see that right now the dot plots as an average come in at 2.85%. Now, this doesn't wait on who's the voter or, where Jay Powell sits on this. So it's not an exact rating, but it is the compass that the market will use. And seeing as we're at 2.25 to 2.50%, this obviously suggests two more rate hikes at the moment. So what the market wants to see is for this 2.85% number to kind of come in a little bit closer to that 2.375, which would suggest no rate hikes for 2019. And then even 2020, where right now we have a greater percentage, I think it's 27%, of people looking for a cut rather than a rate hike within that time frame. So at the moment it sits at 3.07% for FY20, and that needs to be reined in significantly in order for the market to feel a little bit comfortable that they won't get caught up with the Fed just pulling a pivot similar to what they did in January, really, to the dovish side, but a pivot to the more hawkish side and basically keep those dot plots in alignment to allow them to do that. The idea that if the Fed gets a little bit more aggressive lowering these dot plots, it'll kind of, I don't want to say corner them into having to stick to a more dovish outlook, but at least it will take off some of the likelihood that the Fed would be able to pivot as quickly from that dovish take, and markets could get a little bit more comfortable with investing over that 6 to 9 month time frame, as they have a pretty fair idea of where monetary policy stands. So dot plots are front and center. Economic projections, obviously we're looking for that GDP number to be reined in a little bit here. The unemployment rate probably not going to see big changes, but I really think that the inflation numbers will also be a key read for the markets here. As Jerome Powell recently stated in his January press conference, he'd said, I would want to see a need for further rate increases, and for me, a big part of that would be inflation. It wouldn't be the only thing, but it would certainly be important. And I think that puts inflation and those projections front and center. And then, of course, we're going to be looking for any comments on the balance sheet, and there's a number of expectations around that.
So I got a question for you, Gav.
Sure.
So the last time that we did a big Fed preview and Fed Day really was, do you remember the theme that we both kind of agreed on was have your cake and eat it too?
The December meeting, correct?
Yeah, no, wasn't the next, that was January.
Oh, the January one, yes.
Yeah,
okay.
right. I mean, and they managed in that meeting to do something which was really quite interesting, which was to stay really upbeat and gung-ho on the economy, and then also massively shift to the dovish side. And it was kind of remarkable that way, and it seems to me that if they rein in the dot plot, they're not going to be able to pull that same trick, because it will look really odd if they shift the dots down without downgrading in some material way the economic outlook.
Right. I think the only way you can get a cake and eat it outlook this time, Brett, and tell me if you disagree, is and they never target the dollar, but if they really start kind of putting the emphasis on, we're more concerned about Europe and China's slowdown, and we don't want a divergence in our monetary policy, which would kind of be a little bit of Drake saying that, we don't want the dollar to get too much stronger. I think that would be the only way that you could get a cake and eat it here. But really, I think, and we talked a lot about with the FedEx earnings and the BMW and the Samsung outlook. Now, a lot of that was more weakness in Europe and stuff. But if the Fed really reins in that GDP outlook, then that will raise a little bit more concern around a easing monetary policy, I think. So I think the only way that you can get a have your cake and eat it outlook is if they're really putting the blame on the slowdown in Europe and China. Would you agree or disagree with that?
No, I think that makes a lot of sense. I also think you could kind of couch it a little bit in risks to the trade outlook, because we had this idea a month ago that there was a trade deal that was imminent, and that seems to be kind of fading away at this point.
Yeah.
And FedEx is another casualty there. So I would say, yeah, that you're right, they can do a cake and two kind of process if they're able to say there are risks and factors, though the underlying fundamentals of the U.S. economy right now remain really strong. However, because there's the possibility for global pressure to impact the outlook, and because there is, risks to the outlook involving trade, that we want to remain vigilant or whatever on pause. So yeah, I think that's probably true.
Yeah, and it would be curious to see if they did add that to the directive. I doubt they will. I think that would be more something that would come out in Jerome Powell's press conference.
Yeah.
But obviously, in order to do that, they're going to have to reflect. I could certainly expect a downgrade in the GDP outlook, but the significance of that downgrade, I think, will be key for that language.
Makes sense.
All right, so let's say we get a pretty base case scenario. The Fed has been pretty good about telegraphing what they want to say. You guys lay out your scenario, and if everything comes in as expected, what does the market do? Brett.
Well, let me just clarify. So what I think Gavin and I both look at as a real wild card here is whether or not they're going to give any concrete details on where the balance sheet is headed.
Okay.
And I think the market doesn't know what to expect there. There's hopes that they'll say, it's just going to be a couple more months where we've got a baseline. It's going to be higher than we thought before, and we're publicly declaring where the balance sheet destination is, and it's going to be a relatively short trip to get there. I think that would be the dovish swing factor. And if they don't do that, if they say, and I think they won't do that personally. I don't think that's consistent.
I agree with that too. I think they'll say that's the May meeting.
Yeah, I don't think they want to commit to anything right now. I think they're going to kind of go with this data-dependent, pause, wait and see kind of approach. And that's not really consistent with committing firmly to a destination for the balance sheet. And I think that there is money in the market right now that is speculating that they may do that you may get that dovish balance sheet point. And if we don't get that, then I would think that kind of gives you the window for maybe some shorts this afternoon.
Yeah, and again, in my preview, I outlined a few of the numbers that we need to be looking at. One of the reasons why this has gotten so high up and on expectations is Loretta Mester a couple of weeks ago said that the plan could be finalized in the next meeting, and then New York Fed President John Williams, who runs a lot of the day-to-day liquidity operations here, had said that that he expected to end selling assets by the end of the year. And that's really ramped up expectations for the Fed. Just to give you a few numbers here, the balance sheet for the Fed before the crisis was at about $800 billion. It rose to $4.5 trillion at the height of the crisis. It's now down to about $3.97 trillion. originally the expectations were for this to come back in closer to 2.5 to 3 trillion dollars. But if they announce that they are going to be ending it soon, then obviously that sticks closer to the 4 trillion. It'll be a much higher balance sheet than was originally expected. And then there's also the reserves that play in, where current expectations are for this to run around 1.3 trillion. So I would say the best case scenario for the markets would be if they do announce that they will be unwinding this, stop unwinding the balance sheet by September. I don't think that they would do anything in order, and that they would leave their excess reserves above that 1.3 trillion. And then the base case, I think right now, is for them to leave that 1.3 trillion on the table, telling investors that they are going to make a decision in May on this, and that they are under formal discussions. And then the worst case would be if they really don't touch upon it at all, or mention that the reserves could run below that 1.3 trillion. So they're kind of the three outlooks that we're looking for, and I think the markets could see a different reaction to each one. In general, I do expect to see an overall sell the news reaction, but I think it could be a viable drop-off, Brett. I don't know how you're looking at it.
Yeah, I mean, I think it really depends. What is it 50 billion coming off per month right now?
50 billion coming off per month right now.
And so that would leave, they're saying it's going to be done by the end of the year, so that's another 400 billion basically coming off.
By September is the
by September. So that's less than that.
So call it about 250 billion. So I mean, like I said,
where does that get us to?
About 3.75 trillion or so.
So if they announce, I mean, that would be the announcement, right? Is that we plan to take it down to there? Would tell us that that's where we're headed to that September point. I think it's, I think the time factor is the important thing to figure out. I think really the market is concerned with how many more months we're going to have this negative flows on the balance sheet. So yeah, okay.
How do they go about doing that? What's the process that they unwind that balance sheet?
And where do they come up with the numbers and everything?
Yeah, well, how do they I mean, it just doesn't go away by itself. They don't just take away from it with an eraser.
I mean, it's maturity, but plus they're selling bonds to the major bond dealers.
Okay,
yeah.
And then
which is high quality collateral. The bond dealers want it, essentially.
Okay, so there's always demand for it.
Look at interest rates.
Yeah.
That's all you got to do. Yeah.
Yeah.
But, I mean, interest rates have been falling. There's more demand for it than they can meet.
Okay. Well, I mean, that's a good thing. I just wanted to really just put that into perspective of if there was ever a problem. I mean,
well, this is why Gavin and I talk quite a bit about what happens later in the year, and as you start to get to where, what's the budget deficit going to be? Are we really going to be in a situation where, like Jeffrey Goodlock contends, it's really 1.2 trillion already in 2019, and that's all going to be supply from the Treasury competing with what's coming from the Fed. So you got Fed selling, you got Treasury selling more than they have in a long, long, long time, Fed selling more than they ever have at the same time, and then also you got rollover of corporate. So you got all of this massive wave of supply, and the question is, do we continue to have inflation estimates stay where they are to allow people to absorb all that, or is it going to eventually start to break the dam essentially, and interest rates start to move higher just simply because of supply factors? And I think that's one of the big debates that are sitting out there over the next 12 months.
Another thing to keep in mind too, and again, this is something that I would not expect this time around, but more in May, as we get further details, is how are they going to be selling? Are they going to be selling treasuries or mortgage-backed securities? Because right now I believe the breakdown is they're selling 20 billion of mortgage-backed securities and 30 billion of treasuries a month. I'd have to double-check those numbers.
That's right, yeah.
But are they going to be selling the short end? Or are they going to be selling the long end
right.
of the curve?
That's another
because this is going to work into, we've talked a lot about the Operation Twist in the past, and right now the general thought is that they could go Operation Reverse Twist, I guess we could call it, Brett, where they're going to look to steepen the curve, and that would involve selling a lot more of the short-term rates in order to steepen that curve, which would be a benefit to financials. Now, I don't think we're going to get that information today, but that's something else that you got to keep in mind as well. What's the makeup going to be of when they stop selling it? Or are they going to change that before that September end time if they indeed do that? So there's a few things that play in here that you want to be careful not to jump too quickly on headlines.
Let me just make the point that Gavin's pointing out something right now, that a lot of people, I think, take this whole issue way too simplistically and form conclusions that are just really basic of, is this quantitative tightening? Is it really tightening? Because just like he said, if they end up managing to steepen the yield curve and at the same time seed the banking system with a ton more high-quality collateral, which actually allows them to lend more, then it could actually not be a big deal at all if they continue to do this for a while. And it's more a psychological impact about them. This is the opposite of QE, right? So people just take it that way. And I'm not sure that they've done an effective enough job of communicating or messaging around it, because it really shouldn't be that big of an issue what they're doing.
All right. But one thing, Brett, you didn't answer Gavin's question about whether a sell-off might be a buying opportunity.
So I'm like a politician there. I just answer the questions I want to answer.
Hey, I'm gonna hold you. I'm gonna keep you honest here.
I'm ready to run for office. So I think that if it is knee-jerk, it depends. For me, it always depends on the mode of behavior. If I see the put-call ratio rip up, I see a flash kind of flush through levels, I see what looks like people panicking out of some things, and a VIX spike and all sorts of stuff like that on a relatively minor pullback, then absolutely that's something that's a type specimen bull event in an uptrend. The emotion happens fast and early. Those are the viable pullbacks. Pullbacks that are troubling, pullbacks that you want to stay away from, are pullbacks that mature slowly. They happen in a grinding fashion. There's very little emotion early on in the process. The VIX doesn't seem to be reacting right away. Put call doesn't seem to be reacting quite away. But stocks have really kind of dribbled off, and you start to look at, hey, we've got things, back down testing their 200-day moving averages in a week and a half or 2 weeks, and just a grinding, plodding move with no emotion around it, no major headlines. Those are the ones that are usually the traps. But if it flashes down in reaction to a sense that the Fed didn't really hit its dovish target as far as what people were expecting them to do, and we see a lot of emotion, we see a lot of quick kind of trigger selling, we see some air pockets in the tape, then that's just what you have to buy in an upward trending market.
You buying the Qs in that situation, Brett?
I think it just depends on how they match up. I would want to buy the relative strength.
Okay. Let me ask you, Brett, about gold, because I find this one interesting.
Me too.
On the standpoint of, I like it here, but I do have a little bit of concern about the lack of inflation that's in play here. I don't know if that's impacting your decisions on gold, or if you've been looking at it. I know in your morning note you had mentioned something about potential shakeout in gold that would have you interested in it. How much would that inflation outlook play into any potential gold outlook you have? And are there any levels in particular? Obviously, how we get to those levels play into whether or not you'd be looking at it. But when you're talking about a shakeout in gold, is there any levels that you're looking at in particular?
Yes, and I got firm answers to both of those questions. Okay. The first one is inflation. I don't think is remotely an issue for gold right now. I don't think that's the gold has different motivating factors through time. Right now, the narrative for gold is this. At some point over the next, let's maybe 18 months, who knows where, we're going to have a recession. I think that's a reasonable outlook to take at this point, given the advanced stage of the cycle. Given some of the slowdown that we're seeing around the world, we can maybe kind of fuel this along. We can maybe get another high. We're not going to go another 10 years, without a recession. The problem is we did a lot of fiscal stimulus at the top of the cycle. We've got a really difficult fiscal situation right now, and it persists around the world. We've got a lot of factors that people don't understand from a financial standpoint. We've got a lot of serious debt issues, and we don't know what that's going to imply, how much of the burden is going to fall on central banks when we do get around the corner and when we do start to see some kind of contraction, what policy measures we can use, and really it seems like the fiscal side of it's just taken out of the equation. Now, modern monetary theory might have something to say about that, but that's another factor. The factors motivating gold right now, I think, are allocations based on the idea that there's going to be a problem at some point before too much longer, and that problem is going to be another one of these situations, maybe not the same thing at all like we saw in 2008, but another situation where we go into uncharted territory from a monetary standpoint, and people don't really understand the implications of things. And I think that's what we went through from 2008 to 2011, roughly. And it turned out to be non-inflationary. Everybody thought that was going to be massively inflationary, what the Fed was forced to do. And the inflation never hit, but gold, had its arguably its biggest bull run ever. So I think that the move to say, hey, gold is the thing you move into when you think that the stuff is going to hit the fan in some way, and it's going to include variables that people don't understand or aren't readily able to understand in terms of how it impacts large portfolios. So if you have billions of dollars under management, or if you're an individual, a family office with really sizable fortune of wealth, of generations of wealth, and you've got something coming at you that you don't fully understand, that's going to take new theories on monetary issues to get past, then gold is kind of this fallback of, well, I don't know what this is going to mean, but I know everybody else is also not going to know what this is going to mean, and that's probably going to mean that gold is a good hedge for that situation. And that doesn't really necessarily imply that inflation needs to be a part of that picture. It's just a kind of another test of faith in how we're dealing with things from a monetary standpoint, because we're going to be back in uncharted territory on some level without a fiscal tool set when we have to deal with the next counter-cyclical issue. So, and the level, what I would really like to see, is a flush under 1275. It seems to be hard to get, but I hate the pattern right now to just plow into this, and it may force that, but I think that there is time. I think patience is going to be a virtue here. I think we're not at the point of any of the stuff I just talked about. I think that we're starting to get this creeping flows into gold because people are starting to see, this may be a great price for gold roughly in this ballpark, because when we have to deal with this set of unknowns and this set of big theoretical issues, and we're off the map on some level, it may be significantly higher, so maybe just kind of be accumulating a position. I think that mindset is already out there, and it's been happening for the better part of the last 8 months or so. But I would love to see a flush under 1275. It would really make me feel like I can establish a position. There is still falsifiability in my mind for this. I'm not built to be an investor in something like gold. I'm built to be a trader in it, but a trader that can take a small position with a very wide stop and stick with something for a big run. And I would like to be able to say, this ascending triangle pattern on the monthly chart becomes invalid when you see gold under basically 1230 or 1225. So if we get a flush down under 1275 or 1265, somewhere in that area, then I can have a small size and I can have a 30 or 40 point risk. And I know that I'm in for the ascending triangle breakout pattern. I can weather a lot of back and forth, and I can also know that if it hits my stop, it will really be kind of technically invalidating the idea. So I would like to see that, because if I have to buy it here above 1300, then what am I going to do? Risk $75 on per contract basis? Then if I get to 1400, I'm really just 1-to-1 on risk almost. So it's really just a much more difficult setup at that point. So I'd really like to see that kind of shakeout, and I feel like the pattern can give it to me. And I feel like with sentiment where it is, it's likely that we will see some swings in sentiment back toward, hey, everything's going to be fine. And when that moment happens, especially if it happens with a strong dollar, then there's your chance.
All right, and I did post the daily crude chart, and guess what, chart? I already had that 1275 level in from the last time. Still Gator Blue. So there you go. All right, gentlemen, any last words that we need to keep a close eye on for this Fed?
Yeah, I mean, we'll be providing the blow-by-blow as it goes along, and listening into Jerome Powell, of course. But for me, it's we're going to have those dot plots posted shortly after, and the economic projections. So I really want to see what they look like before getting overly involved with any trades and getting a real feel for it. And again, that conference call will start a half hour afterwards. So, we could be seeing something in the directive and then kind of a different statements coming from Powell potentially later on. So I'd be careful not to be overly aggressive on the headlines and wait till you kind of can immerse yourself in some of the materials would be my main point of my main goal of what I'm looking at.
And I would just say, as always, there is a process that happens after every Fed anything, and that is a process of the markets digesting the information. And oftentimes, in January this was a case of it not happening, December was a case of it not happening, but 90% of the time there are a number of head fakes, and those head fakes continue into the evening and into the overnight and into the global Forex markets before sometime, midway through the next morning, you start to get a more pure sort of, here's what the market is really thinking about this. So an initial reaction isn't necessarily indicative of what the market really is going to settle on as its way of interpreting or digesting what the Fed has to say.
All right. Well, good hints, good preview. Guys, thank you so much for doing this. I'm sure the listeners got a lot out of it, and the good news is that you guys will both be here to give us some play-by-play and some initial reaction from what you guys do see and hear. Thank you guys so much.
No problem. Talk to you guys soon.
All right.